Ladies and gentlemen, good day and welcome to the General Insurance Corporation of India Q4 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Binay Sarda from Ernst & Young. Thank you and over to you, sir.
Thanks, Susan. Good morning to all the participants on the call and thanks for joining this Q4 FY24 earnings call for General Insurance Corporation of India. Please note that we have mailed out the press release to everyone and you can see the results on the website as well as it has been uploaded on the stock exchange. In case if you have not received the same, you can write to us and we'll be happy to send it to you. Before we proceed with the call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties and other factors. It must be viewed in conjunction with our businesses because future performance or achievement to differ significantly from what is expressed or implied by such forward-looking statements. To take us through the results of this quarter and answer our questions, we have with us the management of GIC represented by Mr. Ramaswamy, Chairman and Managing Director and other top members of the management. We will be starting the call with a brief overview of the quarter gone past, which will then be followed with a Q&A session. With that said, I'll now hand over the call to Mr. Ramaswamy. Over to you, sir.
Good morning, everybody, and thank you for joining us for this call. And I'm very pleased to announce the financial performance for the quarter and the full year ended 31st March 2024. As we reflect on the recent trajectory of our reinsurance company, it's imperative to acknowledge that the challenges we have navigated, particularly within the realm of property reinsurance, and more prominently the catastrophe segment over the past 6 to 7 years. The landscape, both domestically and internationally, has been marked by a series of catastrophic events that have reverberated across the market, inducing significant strain for all reinsurers alike. Nevertheless, amidst all this adversity lies opportunity, and it is heartening to witness the hardening of markets on the international level, yielding tangible benefit for our endeavors. While it is almost unrealistic to expect an immediate turnaround in our combined ratio dipping below 100, we have managed to bring down our combined ratio to 89% for the quarter, the last quarter that is, on the back of our steadfast commitment to meticulous risk evaluation and underwriting practices. Let me now take you through some of the key highlights of the financial performance. The gross premium income of the company was 8,723.65 crores for the last quarter of 24 as compared to 7,369.74 crores for Q4 FY23. The investment income stood at 2,971.48 crores compared to 2,897.21 crores in Q4 FY23. Incurred claims ratio was at 68.9% in Q4 FY24 as compared to 73.7% during the corresponding quarter of the previous year. Combined ratio stood at 89.26% for Q4 FY24 versus 89.15% during the corresponding quarter of the previous year. The adjusted combined ratio by taking into consideration the policyholder's investment income works out to 88.02% for FY24 as compared to 86.96% in FY23. Profit before tax stood at 3,171.34 crores in Q4 FY24 as against 3,004 crores in Q4 FY23 and profit after tax stood at 2,642.48 crores in Q4 FY24 compared to 2,563.84 crores in Q4 FY23. Solvency ratio stood at 3.25 as on 31/3/24 as compared to 2.61 as on 31/3/2023. Net worth of the company without fair value change increased to 37,581.78 crore as on 31/3/24 as against 32,356.08 crore as on 31/3/23. Net worth of the company including fair value change increased to 81,330.25 crore on 31/3/24 as against 63,749.61 crore as on 31/3/23. On the premium breakup, domestic premium for FY24 is 25,804.02 crores and the international is 11,377.73 crores. The percentage split is domestic 69% and international 31%. There is a growth in the domestic premium by 1.7% and the international book has grown by 1.5%. We remain resolutely devoted to safeguarding our bottom line while targeting growth, ensuring that every facet of our business contributes positively to our overarching financial health. To that extent, we've already grown our domestic business as on 1/4/2024 by a significant margin. At the core of our operations lies an unwavering dedication to risk management, a principle that we hold close to our hearts. As stewards of risk for other entities, we bear a profound responsibility to manage these risks with utmost diligence and expertise, striving to mitigate adverse outcomes to the best of our abilities. As such, we are confident in improving our underwriting profitability on a consistent basis going forward. Having given the highlights now, we'll open the floor for questions from interested parties. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants may press star and 1 to ask question. The first question is from the line of Aditi Joshi from JP Morgan. Please go ahead.
Thank you for taking my question. So just a couple of questions. Firstly, on the underwriting in the health insurance, reinsurance segment. So, can you please help us understand as in what led to the improvement in the fourth quarter? Was it majorly attributed to the group medical side? And the second is on the domestic on the fire segment. So can you just explain or help us understand what led to such high deterioration in the underwriting in that segment? And in this last third question is on the fourth quarter acquisition costs. So the cost ratios have gone up both quarter-on-quarter and year-on-year basis in the fourth quarter. So can you please help us understand the reason behind that? And also, what are your thoughts on outlook, especially on the acquisition cost for this full year 2025? Yeah, thank you.
Thanks, Aditi. Yeah, I'll take fire first. Fire, the combined ratios have deteriorated simply because of the catastrophic events. Now, if you look at India, we have had about 9 catastrophic events in the country during the last year, out of which at least 5 were very significant, where GIC's loss on each of these were at least 150 crores. Now, if I look at the entire catastrophic events which happened in the country, they have typically added about 3,350 crores to our overall losses coming out of these cat events. Which, if you look at it from a overall perspective of the 33,000 plus crores of earned premium that we have had for the year, it actually means that's a 10% share of the losses. If it had been a benign year and if these losses had not been there, our combined would have come down by 10 percentage points. So that is the kind of levels of catastrophic events that we've had in the previous year. So that obviously has had an effect on the combined ratio for fire. So that is where the deterioration has happened. But this is something that we have known over the year because the losses have started from something like June and gone right up to, these events have gone right up to December end. So that is something that has happened in the last year, which have deteriorated fire. On health, you talked about 2 things. One is, of course, the why things have improved. Well, I think the losses have improved simply because some of the treaties that we have written have been very profitable. And that honestly has also contributed to acquisition costs going up. Because when you do write profitable business, you end up giving a bigger portion of commission back to the company as acquisition costs. So actually these both are linked together. The health portfolio has improved because the quality of business written has been good, and these have been basically retail businesses that we have been writing. And obviously, since the costs involved on the direct side is also high for these kind of businesses, our acquisition cost has also gone up. Does that answer you?
Yeah, thank you. And if I can also just follow up on the motor as well, as in this was also a pretty good performance. So given that few primary insurers are not very much comfortable about the motor third party pricing hike, let's say in the full year 2025. So if we were just to assume that the prices in the motor third party segment for the primary insurers, they remain unchanged. So what impact will that have on reinsurance business overall? Because I just want to understand as if the underwriting in the motor segment can be seen as improving in 2025.
So there are two aspects to this. When you look at motor, there is third party as well as own damage. I agree with what you say with regard to third party, and this is something that as an industry we are taking up, that the motor third party rates have not changed for a long time now, and maybe with the way loss ratios are going up, maybe it's time to have a relook at the third party rates, and it's time for a change there. And we stand along with the rest of the primary insurance market in this, and we believe that pricing needs to be managed better. That is on the third party thing. On the motor OD, what happens is there are two problems in that class of business. One is of course the losses which could happen due to catastrophic events. Like in India, the major part of the events are mainly floods, and they normally affect the motor cars, the motor vehicles first. So obviously from a CAT perspective, losses could go up there. Secondly, I think the acquisition costs on the direct side for motor is also going up year on year. So these two really do affect that class of business. We of course try and see that the kind of business that we write from the market are profitable to us. So we are looking at this business keenly. If it works for us, we write. If it doesn't work, then obviously we walk away from that. That is where we are. But I think on the whole, the motor needs to be managed better in terms of the cost and in terms of motor third party pricing.
Okay, thank you very much.
Thanks, Aditi.
Thank you. The next question is from the line of Sanket Gola from Avendus Spark. Please go ahead.
Thank you for the opportunity. Sir, just last year in domestic fire segment, we had a price hardening environment. So a few primary companies are saying that it has softened in the current year. Just wanted to understand how the April renewals have happened in fire segment in the domestic market in the current year. That's my first question. And given we already have one CAT event with cyclone in West Bengal region, then and then monsoon probably one more will be there. If there is a softening market, do you think that combined in the next year could be under pressure from domestic market point of view? That's first question, sir. And second, on Sikkim dam loss, are we fully provided, or there is a potential risk coming from that? That's from domestic market. That's my first question.
Sure. So on the domestic market, yes, you are right that the market has softened a bit. The first April renewals, I think it remained flat from a reinsurer's perspective, but from what we understand, the direct insurers are maybe in the process of cutting prices due to competition. Now, this is something that needs to be arrested, and this is something that we are, focusing on. We are totally clued into this. Our message to the insurance companies have always been that they must learn to manage pricing and they must ensure profitability for the treaties, which give them the capacity to write these businesses. Because if that doesn't happen, if there is no profitability, if losses are getting passed on to reinsurers, then these capacities will no longer remain. And that will be to the detriment of this market. Because if you see, typically insurance companies retain less to themselves and, cede more to reinsurers, especially when it comes to classes like property. So it makes sense to, ensure that these capacities are managed well, are treated well, and that there is profit left at the end of the day for reinsurers. Otherwise, these capacities will go off. So that is something I think companies need to understand, and this is the message that, we have always been giving and will continue to give. And this is something that we are managing, and we engage with the markets to understand how things are happening. Secondly,
compared to last year, how much price correction or price decline you have seen in the April renewals for property price last year, or is it flat year on year?
Yeah. So compared to last year, it was more or less flat. I'm talking of reinsurance rates here. That was flat.
Yes,
but then what will happen is there is also direct, rates that we have to worry about, and that is where we are seeing the softening happening, because there is competition in the market and people are trying to increase their top line. So obviously there is softening there, and that is something that we are looking at very carefully to see whether our capacities are getting compromised in that. So that is on the softening part. Secondly, you wanted to know about Sikkim. I think we are adequately provided for Sikkim, based on the surveyor's report and based on what our actuaries think the loss will be. We have completely provided for that. There is no under-provisioning in Sikkim.
But sir, when the softening market is there and even the primary players are competing on price and given cat events are not subsiding, already one is happening now as we speak. How confident you are that the fire combined ratio will hold up for the next year?
So one part that we have to understand is, in the reinsurance business, it is all about spreading your risks and managing your overall portfolio. And if we end up writing only property business, then obviously we are at risk there, because, like you said, the catastrophes keep on increasing. Climate change is something that we have seen as a reality. Plus, in case pricing goes down, then obviously it is a problem. But the way we have grown our business in financial year 2025 is we have grown it kind of across different classes. A major part of our growth has come from health, especially retail health, which actually is a good spread for us against the catastrophic events that are happening on the property side. So that is something that we are managing. We are pretty confident that we'll be able to manage our combined ratios going forward.
Got it, sir. And second, on the overseas business, our core for the full year is 125. It's still higher, maybe improved compared to the last year. But you spoke about in the initial remark about overseas rate hardening.
Yes.
So just if you can tell us how much rates have hardened in overseas market compared to the last year, and with the rate hardening, assuming similar claims play out, a likely improvement in the combined ratio in the overseas business you expect in FY25?
We do expect improvements, and the reason is very simple. For us, the problem was not property. Property has actually worked very well for us internationally, because that way it has been a relatively benign year. I'm not saying that catastrophes did not happen, but at least as reinsurers, we were a little away from those losses. For us, the problem was one particular contract, and I think I've spoken enough on this in previous calls as well. There was one particular contract that we wrote in the US in the years 2017 to 2020, primarily focusing on marine and motor as classes, and which we came out in 2020. But these are long-tail classes, so obviously the losses have come now. So in the year, we actually ended up paying close to $260 million as losses in this year on this contract. Now, if you see 260 million, close to 2,100 crores, if I had not written this contract and if these losses had not happened, honestly, it would have taken off 20 percentage points from my international books combined. My combined would have been 105% for this year. So, really, it is just one contract which has really skewed our book. So that is why we are confident that going forward in the next year, we will not have a similar problem, because we have already provided the worst case scenarios in our books. Our actuaries have taken into account how the losses have developed over the last 7 years, and based on that, the provisions have been done. For these businesses, we also provide letters of credit, because this is a business in US and we don't have an office there, so we need to provide that. So we have ensured that our books are now ring-fenced. Our portfolio is now kind of in a better position as far as this particular contract is concerned, which is why we are pretty confident that going forward for this year, the international book will look better.
Got it, sir. Perfect. So means just asking from maybe I know you don't give the guidance numbers, but given this 2,100 crores is one-off, maybe 3,200 crores kind of a domestic cat event is also little extreme. If year looks little benign, even if this 2,100 crores don't repeat, then are you very confident that we will be more like 105, 107 kind of a combined in the FY25 compared to 112 what we have reported?
That is our desire. So I'm glad you put the number yourself, but that is our desire, because this is where we believe our book will probably work very well, and then we take the next step towards reaching closer to 100 kind of stuff. But if you actually look at it, I think you put the figures rightly. If you take away these two things, we are actually doing much better than 105. But I don't think we should take the point that we will not have catastrophic events. As a company, we understand that these risks we have to take. These will be there, and we are ready for that. But taking your point forward, yes, if these kind of one-off extreme events are not there, then we are very confident of making 105 to 107.
Got it, sir. And two more questions I had. One is on your rating change. Now your solvency is 325. Yeah. Ideally, you should get re-rated to A plus or A at least. So just wanted to understand the timelines when you are expected to see rating change. One thing, and second, if that happens, a likely impact on the overseas business growth if it happens. That's point number one. Yeah. And second question I had was with respect to crop, sir. See, crop has declined by 27% in FY24. It is closer to 3,600 crores today. So this number will further come off, or this is like a bottom number. Now states have concluded their tenders, 3-year contracts. So you are fairly confident that number might be flat going ahead, or you can see a further pain in growth in this particular segment.
Yeah. So Sanket, I just hope that, apart from being an analyst and an investor, you also are a rating person, because we actually want people like you to think of our rating. But I think you hit the nail on the head when you said that, with the kind of balance sheet strength that we have, the solvency that we have, and things that we have shown over the last 3 years, it's high time the rating agencies realize that. And I think even last year we pushed a lot, and we made these points to the rating agencies that, when you compare ourselves with the rest of the people in the world, we are actually quite strong. And this is not something that we say. This is what our clients say. So hopefully, yes, I think the rating agencies will also look at us positively, because last year when they looked at us, we showed a good profit. Our performance was good. Our solvency had gone up. They could always take the call that this is kind of a one-off. We will wait and see whether this will continue, right? So I think we have now proved it to them that this is something that will continue. And more importantly, in a year which has not been benign for us, there have been catastrophic events. There have been, the stress that we have faced from the motor and marine portfolio. So with all that, for our book to perform the way it has, for our profits to be at the level that it is. In fact, the 6,500 crores net profit that we are talking about is a record profit for GIC. We've never had this kind of profits before. Yeah. So we have obviously shown to the world that, as a company, we are going up. We are looking at ways to ensure that our book does not, collapse in any way due to any event. And we have kind of ring-fenced our risks and managed our risks in a way that it will augur well for the company. So hopefully, I don't see any reason why rating agencies should not look at it positively. We are meeting with them in July, and we will continue to push and get our rating back to A-. Now, the next part of your question is to whether once we get our rating, whether our international book will go up. My immediate reply to that would be yes, because that makes sense. As you become a A- rated company, you get access to better international businesses, which we are looking for. But that doesn't mean that we are going to go complete, hog on growing our book, irrespective of the quality of the book, just because we have got our rating back. The rating will only ensure that we get access to good quality international book, and once we are, comfortable about the business, about what it will do for us, how it will work for us overall, we will of course continue to write and increase our international book. That is for the future.
Got it, sir. And then lastly, on the crop one.
The crop, I think you gave the point yourself. So crop, what has happened is, the tenders have changed. The way the crop business is being done. Earlier it used to be individual years, now they are 3-year businesses. So obviously insurance companies have already done a 3-year deal with the state governments. And changes will happen only in case, there are huge differentials happening in the business. So currently we are more or less flat compared to last year, maybe slightly grown a little bit on the crop business compared to previous year for this year. But like you said, yes, it will more or less remain where it is. It will not go down. In case we get to see some good opportunities because of some reinsurer moving away, then we might look at it. But at this point, it remains flat.
Perfect, sir. I have few more data, but I will come back in the queue. Yeah.
Thanks.
Thank you. The next question is from the line of Kartin K. An individual investor. Please go ahead.
Hello. Am I audible, sir?
Yeah, you are.
Yes, sure. Thanks for giving me the opportunity. Firstly, congratulations on the good set of numbers for this year. So I have 3 questions. The first question is the commission ceded for this quarter specifically has gone up by 80% compared to last quarter. So you said that you were saying that in the first question that it has gone up because of health retail participation increasing for us. Is that the only reason, or any other reason is there? Because it's almost 80% higher.
It could be obligatory PC.
Yeah, there are multiple reasons why it would go up. So one, the major part is the health treaty, because we have written a few treaties which are very profitable. So obviously, what happens is you tend to give back a higher share of the. tend to give back a higher share as commission. Again, obligatory is one area where the commissions have gone up. Not the commissions per se, but what happens is obligatory has a provision where after 3 years, if the company is showing profits, there are profit commissions to be paid back. And if you see over the last 2-3 years, companies have been making profits in the previous years, and so obviously there are elements of profit commission which needs to be paid on obligatory. So all these have combined together to ensure that commissions have gone up. But honestly, we don't worry too much about it, simply because as long as your loss ratios are in control, I think you would expect to pay more for good quality businesses to write.
So that means that the health business going forward will do well for us. Is that the understanding, sir?
Yes. Some of the business that we wrote last year, as well as what we have written on 1st April this year, have been very good quality retail businesses in health. And as you would have seen from statistics as well, health in this market is growing very fast. Whether it is the health done by GI companies or done by SAHI companies, they are growing very fast, simply because I think post-COVID, most people have realized that they need to buy insurance, and those who are already buying, they need to buy more. So health as a class has been growing fast. Retail health has been profitable, and we are glad to be a part of that.
Okay, got it. So, from the growth perspective, so you have been stating in some of the interviews you are giving for the business channels. You said that there's a chance of 30% increase in the domestic business for this current financial year. So the 30% what you said is the obligatory or non-obligatory, or combined both combined?
So the earlier one that I talked about was 30% on the non-obligatory, and not just non-obligatory. It was a comment on the business that we wrote on 1st April. So what happens in if you take non-obligatory in total, there is some business that we write as treaty business on 1st April, and there is some business that is written throughout the year. It could be either facultative, it could be some small treaties that start at a different date. So all these have not been calculated. Overall, if I look at the book today, what we wrote for financial year 24 and what we expect to write for financial year 25, we expect an overall growth of about 15 to 16%. Now I'm talking about this on a total portfolio. So we did about 37,500 last year, that is FY24. We expect a 15 to 16% growth. This will come from domestic non-obligatory, this will come from obligatory, and more or less at this juncture, I think the international business will be flat. The call on international business will be taken once we get our credit rating back, and most of those renewals will happen on 1st of Jan. So obviously at that time we'll take a further call on how our total overall growth is going to happen.
Got it, sir. So another question I have we have accrued cash balances almost close to 25,000 crores. Now, if you see the kind of the past, so we went to 50,000 crores of premium, and then we have come back to almost close to 37. Now, do we need to hold that much of cash in the balance sheet, or it can be deployed productively, like investing in government securities or equities? Just a question on that.
So this actually includes two things, Karthikeyan. These cash and bank balances include our foreign balances as well as our domestic things. So in the domestic, if you see in our overall investment, we have a internal benchmark where we keep about 7 to 8%, 7 to 9% as our as a margin, liquidity margin, because we need to pay claims. And currently, touch wood, some of these things are paying well for us also, because these money market instruments are paying quite well because bank deposits are quite good. Internationally, we do not do equity or bonds or anything. We normally keep it as FDs, because that is what RBI told us earlier. Again, touch wood, because of the war and inflation in the international markets, we have been able to get a much better rate of interest. But this is something that we look at very closely. Our investment department and our accounts department are in regular touch to see that, wherever possible, if we see some opportunities, we'll obviously look at putting money into that. But currently, this works well for us. Again, from a equity perspective, we will more or less remain where we are, because we really don't want to go beyond 17 or 18% on book value basis in equity. That is something that we will retain. Of course, the fair value is something substantially higher. It's simply because our investment department is doing a good job and we are able to get much better returns and much better value for our investments. I think currently we are very comfortable with the way we are investing our money.
Okay, so one final question I have is we have been trying to hire a CFO, and you have tried to hire actuary for general insurance. So both the candidates didn't join the company. Now, any specific reason for them not joining the company?
I wouldn't know. Unfortunately, they never came back to us saying what is the reason that they didn't want to join. Honestly, and I would say that this is their loss, because they would have had a chance to be in a very good professionally managed company which is doing well. And honestly, from a business perspective, they would have got to see some businesses which I don't think any of the insurance or reinsurance company today in India will be able to show. But anyway, we do not have an issue with that. We were looking at trying to see whether we can get people from the market because we wanted to, manage our internal processes. Currently, we do have good people. Satish Bhatt, who is our actuary on the non-life side, continues and he's doing well for us. On the CFO side, we have managed to find a candidate. He was already there, he was with us, but then we wanted to give him other responsibilities, which is why we looked at CFO from outside. But he's there with us, and I'm sure in other calls he will definitely be in touch with you and give you details. So that is an internal candidate, Balkrishna Warrior. He's been with GIC for over 36 years now. He's been a GIC loyalist, understands finance very well. So we are very happy with our candidates that we have. We are also happy with the candidates who joined us. So we essentially went out to look for 4 candidates on a lateral basis: a CFO, a CS, and 2 actuaries. The CS and the life actuary have joined, and I'm hoping that they are happy with the kind of environment that we have given them. So these things happen. I mean, there's no point in worrying about why a person didn't join, or I would be more worried if a person joined and he is unhappy. So that is where we try to provide the best possible, facilities and best possible environment for people to work and grow in this organization, whether they join laterally at scale 7 level or they join at scale 1 level. We want people to join us, we want people to work with us, we want people to grow with us and be happy with us.
Thank you, sir. All the best.
Thanks, Karthikeyan.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. I repeat, you may press star and 1 to ask questions. The next question is from the line of Aditi Joshi from JP Morgan. Please go ahead.
Aditi, we can't hear you.
Miss Aditi?
Hi, sorry, can you hear me now?
Yeah.
Yeah.
Okay, thank you. Thank you for the opportunity again. Just very quick one. So first one, I'm sorry if I missed, but on the credit rating timeline, can you provide some of your guidance as in by when, if at all it happens, it will happen? And second is on the fourth quarter. We previously discussed that the reinsurance pricing in the fire outlook is about to be flat. But can you please share your thoughts as in why the growth in the fourth quarter in the fire premium was very high? And just lastly on your strategy on to contain the natural catastrophic losses. Now it seems like it's going to be a business as usual. So what are your loss limiting strategy over there? Because it seems like we have significant losses coming in recently. Thank you.
So on the credit rating timelines, normally what happens is once we close our annual accounts, we send our data to them. They normally study it and they come and meet us. They come and meet us, to understand the qualitative features that we have done during the year. They've already been in touch with us and they've said that they will be coming and meeting us in the month of July. So typically what would happen is the data would go to them end of this month. They would study that. They would come to us in the month of July. We will discuss. And there will be a few to and fro's after that, depending on the kind of questions they have, the data requirements they have. Hopefully, we would want them to come back with the rating at least by September end, because that gives us then 3 months to really target, international business growth, because most of the treaty renewals happen on 1st Jan of every year. So that is what we would look to, and previous years they have normally done that either end of September or beginning of October we have got our rating. Last year, which is 23, we actually got that pretty late. We got it towards the end of November actually. So even though they had given us 2 pushes within B, we really couldn't use it much because the time was not enough. So we would prefer that, and that's what we would be telling them, that we would prefer to get the rating by end of September, beginning of October, because that is when a lot of conferences, international reinsurance conferences also happen, where we can, target our customers, talk to them about what we have done, and hopefully with a rating upgrade we can, convince them to show us their books which we can write. So that is the timeline that we are looking at on the credit rating timelines. As regards the business for this year, so what I essentially said was there are 2 things happening. One is on the reinsurance side, obviously the rates were flat, maybe slightly higher in some cases, slightly lower in some cases, but overall the market was flat. That is on the reinsurance pricing side. On the direct pricing side, while last year it was quite okay, the beginning of this year, which is hardly now 1.5 to 2 months, there have been some instances where people have pushed down prices. So that is the initial part. We still have 10 months to go. So obviously, like I said earlier, these are messages that we will continue to give to the markets, that they must learn to protect the treaty capacities, they must learn to price properly, and they must not, drastically reduce prices just to grow their top lines. Then these are some things that we'll continue to do. Now that our account closing is done, we'll be meeting our customers, understanding from them how the market is behaving and what their outlook is, and obviously we will keep pushing our messages to all our clients. So that is where the pricing stands. How do we look at the business? We look at the business positively. We believe if the pricing is maintained well, this business should work for us. More importantly, like I said, what we have also done is we have tried to kind of de-risk our entire portfolio by ensuring that we write across classes. So even if one particular class behaves a little abnormally, we have money coming in from the other classes to kind of ensure that the overall book does not become bad. So that is something that we have done. For this particular year, the treaty renewals that we have done, we have kind of grown across most of the classes. Some of the classes we have grown more. For instance, like I said, health, retail is something where we have grown because we've seen the profitability and we are happy to write there. But otherwise, finally we are doing what every reinsurer does, which is spreading the risk either geographically or even within a geography across classes. So that is something that we continue to do, and we are very confident that our book will perform well.
On the natural catastrophic losses, just from a retrocession perspective, do you have any changes in the strategy over there just to limit the losses? And on the premium reinsurance pricing, thank you for sharing your thoughts in the guidance, but I was actually trying to understand it more from fire insurance in particular and for the fourth quarter. So I see that there's a quite good growth in there in the fourth quarter. So if you can help us understand that as well. Thank you.
Yeah, I think the growth is more or less normal in that. I think I'll just ask Rajesh to speak on that. He handles our accounts.
Actually, fourth quarter accounts are usually, there will be changes actually. Say, London office, they book 100% premium and then earn over the period. So the gross premium will look higher in that fourth quarter. Similar things happens, it happens as the accounts we received basically. So this quarter accounts is higher compared to other quarter. It usually happen in the fourth quarter.
Yeah. And especially on the fourth quarter, what happens is even domestically, for instance, we push hard to ensure that all the insurance companies provide their information and their accounts for the quarter, because we need to complete for the entire year. Normally, otherwise, for earlier quarters, there could be an occasion where, for some clients, we might end up estimating because they have not sent in their accounts. But otherwise, for the fourth quarter, normally all the adjustments is well taken care of. And that is where the growth, so to say, is seen. Does that answer you, Aditi?
Yeah, and on limiting your losses on the natural catastrophic side, any plans of change in the retrocession, etc., just so that it's spread out and you do not have any lot of stress on yourself, and if something changes on that side?
Well, not much of a change, because honestly, as a reinsurer who is writing big shares in this market, so on the property we typically buy two programs, one for the international, one for the domestic. Typically what we buy is more to protect our balance sheet. We don't really buy lower level retro protection, simply because of two things. One, it is from a cost perspective pretty high. Honestly, it doesn't leave much in terms of recovery for us, because upfront we are paying a very high cost there. We normally are of the opinion that reinsurers of our size, we should be able to manage the so-called attritional losses. Now, when I talk about attritional losses here, I'm also talking of what we call as attritional cat losses, which means small cat losses, for instance. Now, if you look at the year 23-24, like I said, there were 9 catastrophic events which happened. Now, these are not really small. Some of them were really big. Now, overall, if you see, it added about 3,350 crores to my overall loss. And maybe the biggest loss I got was from Sikkim, which was about 1,000 crores. Cyclone Michong was about 1,000 crores. The North India floods was about 650-700 crores. Cyclone Biparjoy was about 500 crores. So all these were reasonably big events in the market. But then if you see the way our book has responded, we have managed to take each of these losses to our balance sheet, and we have managed it very well. So what I'm trying to say is, typically that is what we would like to continue, that lower level cats we should be able to absorb in our books and manage with our premium. Whereas it is the really big ones which kind of go to, more than 2,000, 3,000 crores for GIC share, that is where we would be looking for retro protection. And this is something that we have been doing over the years, and it has worked well for us. I think our results also are, well managed. There is another aspect here which you would have also noticed in the last couple of years. We have introduced a catastrophic reserve in our books, where from the profits in the revenue accounts, every year we transfer some amount into this catastrophic reserve. And the idea is, when a really big catastrophic event hits us, either domestically or internationally, we will be able to use the reserves or use the amount in this reserve to kind of ensure that the results don't look too bad for a particular year. So I think from all angles we have tried to ring fence our book from potential bad events hitting the market.
Okay, thank you.
Thanks, Aditi.
Thank you. A reminder to all participants, you may press star and 1 to ask question. I repeat, you may press star and 1 to ask question. The next question is from the line of Sanket Kola from Avendus Spark. Please go ahead.
Thank you for the opportunity again. I have 2 data keeping questions. Can you tell me the capital gains booked in full year and fourth quarter, for the fourth quarter 24 and FY24, and also the amount of dividend income? That's my first question. And second question is, tax rate for the full year is around 18%. So you expect the tax rate to be at the current level, or it will inch back to 25.2 kind of a number?
Okay, so capital gain will be handled by Radhika, who is our Chief Investment Officer, and tax will be handled by Rajesh, who is our finance guy.
So tax rate is same as last year, overall 25.168. So 22% is the tax rate, 10% is surcharge, and 4% education cess thereon. This is on net basis coming lower because of the 152 crore we have pertaining to previous year is now we have received the order and accounted for in our books. So otherwise tax rate will remain every year same as 25.168 as the government will announce.
Got it. Perfect, sir. And capital gain, sir? Sorry.
Capital gain is
for the quarter, sir, the profit on sale is 1028 crores, 29 crores, as against the this thing. And for the full year, it is 4135.
135 crores. And can you tell me the corresponding numbers for last year, ma'am?
4451 last year.
4,451
crores.
Okay. Perfect. That's it. And lastly, if you are okay, sir, to give a growth guidance for FY25, what the GWP growth you are expecting, and that too split between domestic and overseas?
So the growth will be, as I said, it should be around 15-16%. This is based on the growth that we have done on the 1st April renewals. This doesn't really take into account what we will do during the year. It also doesn't take into account what we will do during 1st Jan renewals for the international book. Because the 1st Jan renewals will depend on our getting the credit rating. If we get a credit rating, we might end up writing a bigger book simply because of the better quality business that we are able to see. So whatever growth projections we have said, so I told that we'll grow about 15-16% year on year for this year, that is FY25. It is based on what we have grown on 1st April. It is based on the obligatory increase that we expect. Now, like I said, this would all depend on how the market grows. Again, in India, a major part of the treaties that we write are proportional. So when it is proportional, it is also dependent on the insurance companies. So overall, we have looked at the market growing maybe about 10 to 12% year on year, and on that we have based on how much of that would pass on to us in terms of business. On that basis, our growth will be about 15 to 16%.
So when you say 15 to 16, it's only domestic, or you are including both domestic and international?
I'm talking of the total figure. So we finished FY24 with 37,500 crores.
Mm-hmm.
Right? So about 15-16% on that will be about 6,000 crores. So that is the growth we are looking at.
Perfect, sir. That's it from my side. Thank you very much.
Thank you. Ladies and gentlemen, as that was the last question for the day, I now hand the conference over to the management for closing comments. Over to you, sir.
Thank you, everyone. So thank you for taking time off and listening to us and asking us about how we see the business. We look at it very positively. I think the year, in spite of all the challenges that we have had, we've done well. The combined ratios, even though it is higher compared to the previous period, is still well within what we wanted it to be. So from a performance perspective, we are very happy with what we have done. Investment as a portfolio continues to do well. It is something that is running on well-oiled engines. The worry has always been the performance of the actual business, the reinsurance business that we do, because climate change is a reality. Catastrophes are increasing in terms of frequency and severity. So I believe that the way we have managed our books, the way we have managed to spread our portfolio, the way we have managed to grow in the domestic market augurs well for this company, and going forward we will continue to do well. We'll of course be in touch with you every quarter, and even within that, if you have some questions, please feel free to speak to us or write to us, and we'll be more than happy to provide you the information. We'll of course keep speaking to you and giving you details about how this company is performing. Thank you for taking interest in us, and have a great day. Thank you.
Thank you, sir. On behalf of Journal Insurance Corporation of India, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.